Hello and welcome to the Closing Beat, everybody. Happy Tuesday. How you doing out there? Hope all is well. Thank you for joining us here. We are financial advisors with Jazz Wealth, and we're going to teach you something today. We'd like to use this class to review the stock market, go over how everything's going, and of course try to teach you something in the meantime. If we look at the performance of the markets in here, we have this recent breakout that we talked about failing or pulling back and giving you a little pause for concern. And really, we haven't yet to see any sort of exciting move higher, and that's all debt ceiling driven, but we'll see how that pans out. The trouble here is dollars are chasing momentum. And that's just another way of saying what I've been saying is there's only a handful of stocks that are lifting the market, or in this case, holding the markets up. It's not a good thing. We can actually look over at the kind of a geeky way of looking at it. Stick with me for a second. So what I did is I plotted on the x-axis down here, we plotted the year-to-date returns. Right? And then on the y-axis up here, we actually plot the 1 month returns. So in other words, we're looking to see, are those stocks that are performing well year to date those that are performing well over the last month? Or are people picking on the weak stocks year to date over the last month? So we're just trying to get a glimpse of what's going on there. Well, in fact, the further to the right you go, we see, okay, those are the best performing year to date stocks, okay? And then the further up you work, those are the best performing 1 month stocks. So that shows you that over the last 1 month, people are chasing and still investing in the best performing stocks. They're not interested in the discounted stocks right now. You can see actually over here, year-to-date performance on the really weak stocks is not the best performers over the last month. So it's kind of a geeky way of looking at it. And by the way, the top right stocks that you see over there, that's your AMD and Meta and Nvidia. Those are the ones that are, of course, off the charts. But there's a general trend towards chasing momentum. That's not a good thing. Right? We need a broad market movement. We want to see that all stocks are trending higher in order to believe that things are good and will continue to get better, meaning the stock market will continue to rally higher. That's not a good thing there, right? All gains, let's just do it this way. So all of the gains that have come over the last 1 month, so this is a 1 month returns, about 149 points in the S&P, they have all come from 7 stocks. And Alphabet just has 2 classes of stocks, so there's not 8, there's 7 stocks there. So if you add up all of this, you see, well, that's how we got the gains. It wasn't from a broad market rally where maybe Nvidia accounted for a couple points and Microsoft a couple points and Lowe's Home Improvement Stores accounts for a couple points, maybe a point. You don't have that. You don't have Pepsi in there helping out. There's none of that. It's all these stocks, which is fun on the way up, but can be disastrous on the way down, because what are you doing? You're going over here looking at this going, oh, I want those stocks. I want to participate in all that. That's going to prove a little bit costly if you continue to go that route. Now, I'm no dummy. We manage our own funds here at Jazz Wealth, and so our large cap fund, which we benchmark to the S&P, is literally beating the S&P by 3 times what the S&P is providing. And I'm not stupid, right? So that is because those big names that are leading the way right now, they're pulling up the performance, right? So if you look at your large cap growth funds, anything that you have in that camp or index related funds, you're going to see, wow, that performance is really good. And you have 2 choices. You can either A, try to look like a hero, right? I could go pitch this to clients and go, look how well we're doing. Oh my gosh, we're beating the devil out of the stock market. Or we could be reasonable about this and realize that that trend, right, what you see going on here, this really fast and awkward move higher, is not going to continue. It's not possible. Any stock, any commodity, any asset class you want to look at, even homes, cars, during COVID, when those things get too extended, price extends itself too fast. Use inflation, for example. When inflation rallies so fast, it's not sustainable. The panic sets in, the greed sets in, of course, but it's not sustainable. What happened to inflation? Inflation is literally falling just as fast as it went up. 11 months up, we just hit 11 months straight back down. That's the way it works. So you can either be a hero and look kind of cool in front of your friends, or you could say, let's lock in some of that. Let's slow this sucker down, right? So that we don't have to be so hot, right? Running a portfolio so hot. So that is most certainly what we're going to be doing there. So One thing I want you to remember as we kind of talk over the next couple weeks, and I pointed this out a little bit, money is moving out of the market. Picture this, like just a couple years ago, if NVIDIA would have done as well as it's doing and all these big cap tech stocks. Let's imagine they're doing as well. The stock market would be on fire. Like we would see this parabolic move higher. Remember that? When there was good news, bam, it would take off. Sometimes when there was bad news, it would just take off. Why don't we see that anymore? We see really good news on the inflation front, on the Fed front, on the debt ceiling front, on tech stock front, stabilization in interest rates. There's a lot of good stuff going on. Why isn't the market just blasting off to highs? It's because people have other things that they can do with their money. If you want to take little to no risk at all, and you've got this chunk of money, you have other options than just throwing it in the stock market. You didn't have that a couple years ago, as close as even 2 years ago. So we can actually prove that, and we can see, let's look at the money. Where is it going year to date so far? $707 billion have moved into a now $7 trillion money market fund base, right? We know now I can get 5% over here. I'm really taking no risk. I can switch money market funds. I can go to a better one. I can go to a different one. I can go to the ones at my bank. I can go to the ones online. But I've got $707 billion, and I want to keep it safe. That money used to be in the stock market. Where'd it come from? Right? It had to come from somewhere, and we were all in the stock market because that was the best we could do for years and years and years if we wanted any kind of yield at all, because bonds were yielding nothing. The stock market itself, year to date, has lost $58 billion. That's kind of interesting. So if we go over here to the stock market, sure, summertime, it's going to slow down, volume's going to get a little quieter, but there's just no money, right? Good news is great, but it's not lifting the markets in that parabolic way that we would normally look at. So the question from here is, where do you go? We've got really overbought tech stocks out there. We know they're lifting the market. That can't go on forever. I've got some of that. I want to pare that back and maybe take some of my profits, reallocate my money somewhere else, right? It's called, normally you would talk about a rebalance in your 401k. Super heavy in large cap right now because it's done so well. Well, I don't want to keep it that way because if the market falls, I'm going to fall just as fast. That's kind of horrible. Let's put it somewhere else. Where do you go? You better start getting familiar with small cap stocks. In particular, you want to start getting familiar with small cap healthcare stocks and small cap financial stocks. That's where the money is starting to move. And again, you can just kind of follow it there and see. The Russell 2000 rebalances itself once a year. And in about, it's almost June, in about 3.5, almost 4 weeks from now, the Russell 2000 is going to rebalance, meaning they're going to take some stocks out and they're going to put some stocks in, just like the S&P does periodically, though they don't have an actual schedule. Russell 2000 says we do this once a year. They announce the date. That date is June 23rd, I believe, June 23rd or 25th, somewhere in there. Expect about 250, I'll even go as far as say 260 names to be added to the Russell 2000. Types of stocks you think they're going to be adding? They're going to be adding healthcare, and they're going to be adding financials. Again, small cap stocks, little names you're not used to hearing. It's not the Microsofts of the world. This is small cap, meaning companies that have small worth, right? They're growing. They're just little companies at the moment there. I'll give you a hint. Over 50% of all additions will be healthcare and financial stocks. So if the Russell 2000, remember, people say if you're in the small cap index fund, you can't beat the Russell 2000. That's what goes on out there. Well, it's about to make a big change, right? So if you could know what they're already going to pick and put in there, they're no dummies, right? They know what they're doing, just like the S&P. They're no dummies. When they put a stock in there, take one out, they know what's going on. There's nothing there. So where do you look inside of the Russell 2000 if you're going to be doing this? The trouble is, I just did a scan of the whole Russell 2000, and you have about 40% of names that will have earnings growth by 5% or more. Okay, that's not bad, but that's a lot of names to look through there. So we want to be picky about where we look. If you're going to take some of your large cap money, swing some of that profit there, slow things down a little bit, move it into small caps there. We want strong, profitable growth. The key word there is profitable. The market right now and investors don't want stocks that are maybe going to be profitable, and there's a chance that things go well. They don't want that right now. We want strong, profitable growth. The better, right? We also want a strong balance sheet. Those are the only two things you need to look at. You could set scans for that and go look and do all that. I'm not allowed to actually give you specific names here, but strong balance sheets. Why? What does that mean? Do you think as a small company, borrowing will cost you more or less than if you were Microsoft? It's going to cost you more, right? You don't have the same connections. You're not as worthy of the money at a discount. And so if we have a strong balance sheet, we know that those companies most likely won't need to borrow money, which means that high interest rate environment won't affect them as much. It won't ding their earnings overall. So we want really strong profitable growth, profitable being the key word, and we want strong balance sheets if you're going to look inside of the Russell 2000. There you go. Now, looking at the S&P, you have no real reason to believe this is just going to take off. Obviously, we want it to do well, but there's just nothing there unless the other 492 stocks, 93 stocks, start participating. They're not participating. They're not doing bad. They're just not participating in all this excitement that is wrapped around AI, right? Now, the NASDAQ's a little bit different story. Of course, that's like tech driven and everything. Super extended here, way overbought. What did we just talk about a second ago? You cannot sustain that. It will not stay there. NVIDIA will not stay there. The NASDAQ will not stay there. There will be a breathing mechanism. Like we breathe in, we breathe out. That doesn't mean we have to exhaust all the air that we just breathed in, but it does mean we need to take a break, right? Just calm and relax there. So hope that helps you guys out today, trying to teach just a little bit. By the way, if you're a client, our Wine and Wealth class last week, spot on from the debt ceiling, discussing how that's going to work, and even down to the spending cuts. Spending cuts coming in at 0.1 to 0.2%. What was the magic number we guessed? 0.2%. So getting a good read on old Congress there and what games they're playing. If you want to know kind of get past the headlines of how things work, well, go check that out. If you're not a client of ours, I hope you'll consider joining us. We are at jazzwealth.com and happy to help. We'll see you next time. We'll be back tomorrow to do this all over again. Thanks for watching. Hope you learned something.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.